President Trump loves burgers.
The Big Macs are great, the Quarter Pounder with cheese. I mean, it's great stuff.
And today, we're using his favorite meal to unpack how inflation and tariffs are squeezing the US economy through the lens of Big Mac Index. The Big Mac Index was created by the Economist as a fun way to compare the prices of the same product in different countries to assess the purchasing power parity of the currencies. For example, if a Big Mac costs about 25 yuan in China, or roughly $6 in the US, and that implies an exchange rate of about 4.24 yuan per dollar, which is quite different from the actual market rate. So, what does the latest data tell us? Comparing July's index with January's, the price of a Big Mac in the US has risen from $5.8 to about $6, despite the dollar weakening by roughly 10% since the start of the year. Meanwhile, in China, the price has stayed steady at 25.5 yuan, and that means the dollar's purchasing power is declining. And the main culprit is inflation. Consumer prices rose 2.7% in the year to June, marking the fastest pace since February. And it's not just inflation eating into wallet. Data from Yale Budget Lab show that Americans are now facing an average effective tariff rate of 20.6%, which is the highest since 1910. And that cost is already baked into daily purchases. Just like The Economist pointed out that Americans are now dealing with the double whammy: higher prices driven by the tariffs and the weaker dollar. Well, of course, the Big Mac Index isn't perfect. It mainly focuses on physical goods, while services make up a much larger share of today's economy. Plus, McDonald's prices vary between countries depending on branding, local competition, and market strategies. Still, for burger lovers in the US, the Big Mac may be more than just a tasty food. It's a sign of how much more you need to spend because of inflation.